Okay, so let's begin. Hello, everyone, and welcome to the quarterly investment call for the UTI India Dynamic Equity Fund. The agenda for today's call will be an introduction and welcome by Shweta Rungta, Head of Product at UTI International, a macro update on India by Vetri Subramaniam, Chief Investment Officer at UTI AMC, followed by a fund update by Ajay Tyagi, the portfolio manager who's been managing the fund since its inception. So we'll now begin the session. Kindly note the session is recorded and we'll have a Q&A session at the end. Feel free to post your questions in the chat box at any time during the call. I'd now like to invite Shweta for the welcome address. Over to you, Shweta.
Welcome, everyone, and thank you for joining us today. India continues to be a standout story in global markets, not just for its scale, but also for its resilience and long-term potential. We have now overtaken Japan to become the world's fourth largest economy, and the momentum is real. GDP grew 7.4% in Q1, and FDI touched a record $81 billion last year. These are signals of strong investor confidence. On the macro front, things are turning more supportive. Inflation has eased to 3.2%, and just last week, the RBI surprised with a 50 basis points rate cut, marking a clear pivot towards growth-oriented policy after years of caution. What's remarkable is how well Indian markets have absorbed a string of global shocks. From US tariff volatility to renewed India-Pakistan tensions, and even a terror attack earlier this year, markets have continued to hold up. And as Morgan Stanley notes, Indian equities have quietly derated relative to global assets, making them look more attractive on a relative basis. Beneath the surface, India's core strengths are holding steady. Macro stability is intact, retail flows have remained strong and consistent, and we are seeing early signs of a capex revival and corporate balance sheet repair. India is also asserting itself more confidently on the global stage. Meanwhile, foreign investor positioning remains at one of the lowest levels in over 2 decades. But we are beginning to see that changing. If it does, it could add another leg of support for the market. So yes, global risks remain, but India continues to offer a compelling case as a low beta, high conviction market that is well positioned to outperform in a world searching for growth and stability. With that context, we'll now walk you through the broader macro setup and how our portfolio is aligned for what's next. Thank you, and over to you, Neha.
I think, Vetri, you can start with the macro update.
Sure. Hello, everybody. Good morning, good afternoon, good evening, wherever you're logging in from. Thank you, Neha, and Shweta, thank you for setting that context. And so as we do this every time, I'll just open up with some broad comments on the markets. And also very happy to see that we've already got a long list of questions that have come in. Maybe that's also because there's been a lot happening in India and around the world, and everybody just wants to understand how we think about some of those issues. So some of that will hopefully get covered in the presentation itself. But very happy to take on some of those questions as well as anything new that may come to your mind later on. So we'll just get rolling with the presentation, which is now hopefully up on the screen and visible to all of you. So we'll just dive into what's been the biggest topic of discussion. Certainly, what was the biggest topic of discussion going back in April. Yeah, we can just move to the next slide. Yeah. So, I won't spend too much time on the left-hand side. I think all of you are familiar with how much of a moving target US tariffs are. One day they're on, one day they're off. Negotiations are going on. We're about a month to the deadline by which we hope to see some bilateral trade agreements being reached, certainly in the case of India as well. But it's going to be pretty much a photo finish from at least the messaging that we are hearing. It also certainly looks like 10% is sort of the base case tariff because that's what the US's best friend, UK, has effectively got in the treaty that they appear to have negotiated. So 10% really becomes the base case for pretty much all countries, which also is very much significantly higher than the average tariff level that existed prior to all of this in 2018. But as I said, it's still a moving target. Now, I think the main point that I would draw your attention to on the right-hand side is that, look, at the end of the day, India's exports to US, and I'm talking about goods exports over here, are barely about 2% of GDP. No doubt there could be individual companies, individual sectors that could get impacted quite dramatically based on how this tariff negotiation goes. But really at an aggregate GDP level at 2%, it is not really very relevant from India's point of view. And of course, I do breathe a sigh of relief that all of this discussion is happening as regards goods trade, as opposed to services trade, where India's exports to the US and the contribution of net service exports to the current account deficit is a big positive number. So all of this, conversation happening only about goods is good because that's a small number for India. Because of the fact that eventually the outcomes could be very different for sectors and for different countries around the world. Yes, some companies in India could suffer, but higher tariff rates in other geographies could also become an opportunity for some Indian companies and sectors. So which is why at 2% of GDP, I don't think the economy or total market is really starting to worry or get too perturbed about it. Obviously, on the right side of this chart, you see countries like Singapore, Vietnam, Malaysia, where the exposure to China or the exposure to US in terms of exports is far more significant, and therefore this is far more material to them, particularly because we are talking about goods exports. I know we've got questions on this. We'll take them up later, but I just wanted to give you the big picture that really, this doesn't impact India too much because it's a very small portion of our GDP. Moving on to the next slide, and this is in a slightly different direction. But at the same time, you could say that, every trade war is also at some level a war about capital. It's also a capital war, because remember, these two are just mirror images. Whatever happens on the trade deficit or trade surplus front will then get reflected appropriately in either a capital surplus or a capital deficit. So these are merely two sides of the same equation, and therefore it's very interesting to see, because remember, trade, because of protracted negotiation, the time it takes, the trade and the global supply chains to readjust, it's a very protracted process. But capital flows can react a lot more, sooner, a lot more instantaneous in their reaction function. And you're seeing some part of that where we've pivoted from maybe 6 months ago, I may have on the same call talked about US exceptionalism, and now we've pivoted 180 degrees with the dollar actually completely giving up the gains that it enjoyed leading up to the election of President Trump, and in fact, breaking down to a multi-year low. Of course, it's only, I would say, so far a garden variety correction of about 10%, so nothing really that significant to shake the markets. But just given the dichotomy of how the bond yields are behaving relative to the way the currency is behaving, if you look at the pattern on that chart on the left-hand side, you'll see that the reaction of the bond market so far is very different from what it's been in the past when the USD starts to sell off. And on the right side, you see the typical reaction from emerging markets. What we've done on the right side chart is inverted the US dollar index, which is why when that US dollar index appears to be going up, which is the dark line, you are seeing emerging markets rally. And similarly, when the USD depreciates, or rather when the USD appreciates, we've inverted the line. So you're seeing the dark line falling, and EMs actually at that point of time, start to decline or start to underperform. So this has been the historical relationship between emerging market equity performance relative to DMs when the dollar appreciates and when the dollar declines. It's typically moved in the opposite direction. Are we at the start of that? Maybe a 10% move in the dollar is not enough, but historically the moves or the big readjustments have been far larger. Is that something that will come to bear in the days and more likely the years ahead, that's something which, the jury is still out there, and we'll have to see how this plays out. Moving on from this, sort of pivoting a little bit more, and I think this is interesting because this is the comparison of how Indian bond yields are behaving relative to how US bond yields are behaving. First, on the left-hand side, we've got the India-US inflation differential plotted alongside the India-US rate differential. And as you can see over there, the India-US inflation differential pretty much at the lower end of the range we've typically seen. The gap is down to about 100 basis points. This is very low. Historical average, the gap has been much closer to maybe 300 to 400 basis points. So this is a very low differential in terms of inflation. Equally, this is pretty much the lowest differential that many of my own bond fund managers have seen in their career, because if you look at the India-US rate differential, which is the orange line on the left-hand side, it's currently down to slightly under 200 basis points, and only people who started their career before 2004 have witnessed something like that. For the last 15 to 20 years, that differential has been closer to 250, 300 basis points or more. So this is very unusual in terms of the gap differential between Indian bonds and US bonds. We are talking about long-term bonds. You can see the chart of that on the right-hand side, and how from 2022, the India bond yield on the left-hand side has gently trended lower, plunging more sharply in recent times, whereas the US bond yield has held its ground. This is quite different from the past, but I would actually submit that this is now slightly more structural, presuming that both countries hold their trajectory in terms of fiscal discipline or lack of fiscal discipline. In the case of the US, I think this might well persist. India has actually halved its fiscal deficit from the year of the pandemic. It's pretty close to where we were in terms of the fiscal deficit pre pandemic in 2019, just about 100 basis points higher. So significant compression, unlike the US where it's continued to expand. And in fact, what India has now articulated is a desire to bring down the debt to GDP ratios for India as well over the next 5 years. So very different thought process underway, and that's perhaps causing these bond yields to diverge significantly in terms of behavior. Now, every time you see divergence, many people would tend to think about a mean reversion trade, but really, I think this time around, I would look at this as something structural rather than being an opportunity for a mean reversion trade. Moving on from this quickly to the next slide. What has the Indian Monetary Policy Authority been doing? They started to cut rates much after the US Federal Reserve did. US Federal Reserve first cut rates way back in September, October of 2024. The Indian MPC did not cut rates till early part of this calendar, but they've been very aggressive, unexpectedly cutting 50 basis points in the policy rate last week. So a cumulative 100 basis point policy rate cut just in the last, about 4 months. And I think where this is coming from is the fact that inflation in India is well within the comfort zone of the RBI. There is a sense that, the macro-prudential, the sort of priority that Indian policy authorities have given to macro-prudential economic management means that, whether you're looking at money supply growth, whether you're looking at the fiscal deficit, things have been managed very prudently, and perhaps in some senses responding to what we are seeing as a slight slowdown in growth, what we are seeing as an uncertain environment globally. The Monetary Policy Authority is now feeling comfortable enough to say, let's start to put some fuel back into this engine. And I think that's what particularly the actions of the MPC combined with the actions of the Reserve Bank of India over the last 3 months all lead us to believe that we are now entering an environment where the central bank and the MPC are both quite comfortable with keeping liquidity benign. They're comfortable with the fact that inflation is benign, and they are very comfortable with the fact, or rather they would like most probably to see credit growth start to pick up again, because credit growth has slowed quite significantly over the last 24 months. Moving on from this to the next slide. Just a quick point, and this again, bridges both between fiscal policy and monetary policy. The central bank in India has been able to pay a dividend consistently in most years to the fisc. This is unlike the case of some of the central banks who engaged very aggressively in quantitative easing and now have a loss that they are carrying on their books. Not true of the Indian central bank. They made a fairly large dividend payment to the fisc, and to my mind, this just sort of helps the Indian government manage its fisc, along its desired trajectory, which is almost like a 40 basis point compression that they are targeting during fiscal 26. So this dividend helps them stay on track to sort of achieve that target. Equally, what this dividend does is it improves the core liquidity within the system. Those of you who've been following this, the central bank was keeping liquidity very tight in India. I would say all the way till about February 2025, the interbank system was actually in a deficit. So, the banks were short of maintaining their reserves, but that has now pivoted very dramatically over the last few months because of the actions of the central bank, including in their recent policy decision last week by the central bank, where they have effectively telegraphed 100 basis point of loosening of the reserve requirement between August and September, which is well timed because typically credit growth in India has a seasonal uptick in the second half of the financial year. So it's well timed to sort of boost core liquidity. So both the reduction in the reserve ratios and this dividend actually contribute towards enhancing core liquidity, which in turn supports the banks in terms of enabling them to grow credit much faster. So moving on from this to the next slide, I'm going to pivot a little bit on this slide just to make 2 points. Yes, the rupee is appreciated very marginally against the dollar year to date, or at least from its worst point year to date. But we just need to keep in mind that if the rupee appreciates against the dollar, there are significant savings which are generated for the economy, and some of this also gets reflected in the Indian fiscal balance because of the fact that oil, LNG, coal, which is essentially our energy requirements, a lot of those are imported, and that drop very much translates into savings for the domestic economy and some of it directly into the fisc as well. So, crude prices being down 15% year to date. This was as of, I think, the 30th of May, maybe still down about 10% year to date. Combined with any appreciation in the currency, if it were to happen, very marginal so far, but let's say it achieves another 2 to 3% appreciation based on how the dollar behaves, starts to contribute significantly to improved quality of fisc and a energy cost saving for the economy in general, which creates a positive backdrop along with the monetary policy actions that the RBI and MPC are taking. Moving on from this to the next slide, I'll just sort of, once again change the, parameters that we've been talking about, coming to talk a little bit about profit growth. One reason to do this is that, remember, the fiscal year in India is March every year. So March 2025, another fiscal year is complete. And this gives us a good opportunity to sort of look at how have profits in India behaved over a long-term cycle, right? So we are going back to the pre-pandemic period. So we didn't even look at 19. We actually went back all the way to FY 19. And then we looked at, how profits have behaved for large cap companies, mid cap companies, small cap companies. And you can see there's a lot of fluctuation happening over there. But obviously the fluctuation is far more significant in the small caps. So in their worst year, they are -3%. In their best year, they are +28%. If you look at the large caps, their mean around which they are fluctuating is a lot more in the middle. And then the mid caps as well have slightly greater volatility in their profits. Interesting thing, if you go back to the pre-pandemic period and then look at the performance over a 7-year period, it's almost synchronicity, right? I mean, 15% profit growth for large caps, that's the compounded annual growth rate over a 7-year period, 15% for mid caps, 14% for small caps. So, Ajay will talk later on about the UTI dynamic equity fund. It's a very bottom-up strategy. We don't really think about large cap, small cap, mid cap as allocation decisions. But I know there's been a lot of conversation about this in recent times simply because the performance of small caps relative to large caps in the last 18 months months looks very, very different, or maybe 24 months looks very different. But important to realize that the fuel for performance essentially is profit growth. And when you look over long cycles, actually, those numbers tend to converge, though in individual years, they could look very different. One final point I'll make on this. This is profit after tax growth, and I would submit, though we're yet to sort of get that data through in its proper context, but hopefully we can come back in our next call and talk about this, that if you look at EPS growth, because eventually equity outcomes are related to EPS growth, not just PAT growth, my gut feel is that the level of dilutions in small caps being the highest on EPS growth, it might actually be the large caps which have the longer term best performance, and small caps actually much lower on EPS growth because they tend to require capital a lot more to grow. So they also tend to dilute a lot more compared to their large cap brethren. Finally, moving on to one more slide where again the talk is about estimates rather than the past earnings trends that I talked about on the previous slide. And the reason I'm highlighting this is that beginning Jan 2025, though you could argue, the slide over here looks at consensus estimates for FY26, which is the lower line, consensus estimates for 27, which is the upper, thicker gray line. And you can see the trajectory that they have followed over the last, almost 1 year. There is a gentle decline in that number, but I would particularly point to, Jan 25 for the FY26 EPS, and you can see how that number has consistently been trending lower. For those who are, perhaps not able to see it as well, that number in terms of the EPS number for the Nifty was estimated about 1225, 1230 in January 2025. As we speak today, it has dropped lower, closer to about 1160. So there's been a significant cut in EPS growth estimates. Some of that has got to do with the disappointing numbers in the middle of last year as far as GDP growth outcomes were concerned, and some of it just reflects analysts starting to factor in uncertainty related to the outlook for growth during the current year because of tariffs, because of so many other moving parts, and earnings estimates have been cut quite significantly over the last 6 months. So that's the purpose of sort of highlighting this slide. Estimates for 26 and 27 have been cut. I think they reflect in part the uncertainty over tariffs and the outlook for global growth. So if things were to, very quickly fall in place, maybe you see this integer start to go back up again. But right now, to me, this is more a cause for concern rather than a reason to feel comfortable about the way markets are behaving. Moving on to the next slide. Here we are talking about more long-range trajectory. March 25 estimates, a few numbers still yet to come through, which is why it's still estimate. 9% earnings growth is what has happened in the year gone by. And the estimate for next year is 8% growth in EPS. This number used to be at closer to about 14-15%. But, as I said, over the last 6 months, we've seen significant cuts to this number. We've also simultaneously seen cuts to the FY27 number. So the growth rate, which previously looked like 13-14%, is intact. It's now at 12%. But effectively, you have seen that EPS number, Bloomberg consensus, being cut. So that's where we stand in terms of earnings growth. What does the picture look like in terms of valuations? Very quickly, that's on the next few slides. On the left-hand side, the Nifty 50, which is effectively the valuation benchmark for large cap companies in India. The yellow line is the long-term average. The white zone is what we would call the fairly valued zone, plus or minus 1 standard deviation. Trailing valuations are in the comfort zone. On the right side, the forward PE multiple is actually climbed back into what we would call the expensive zone. On the next slide, we are looking at the same Nifty 50, but we are looking at it based on price to book ratios. Over here, the takeaway is slightly different. It's sitting somewhere in the middle in the fairly valued zone, above the long-term average, but in the fairly valued zone. So essentially, I would say that's the zone in which valuations don't give you a great signal to take a very aggressive positioning towards India, particularly as far as large caps are concerned. Moving on to the next slide. This is where we have the mid cap and small cap valuations. Now here the picture is very different. To cut a long story short, Nifty mid cap 150 price to book very much in the expensive zone. So on a top down basis, that's not looking particularly great. Similarly, Nifty small cap actually trading at a premium to large caps doesn't give us much comfort. So on a top-down basis, as an asset allocator, these are not two areas which we feel excited about. But of course, when Ajay talks about it, and he'll talk about his portfolio strategy, that's completely coming bottom up. It's not to do with a top-down asset allocator thought process. Moving on from this to the next slide, which again is about valuations. I won't spend too much time on this. This is just something we run internally to sort of look at, bonds versus equities on a 1-year time horizon, what looks more attractive. So when you're in the pink zone, fixed income is more favorable. When you're in the green zone, equities are more favorable. This is not an indicator you can track very often, but once in a while, when it moves to extreme percentiles, it's a very powerful indicator. After spending a consistent amount of time somewhere in the middle of the pink zone for the first time, because the market did see about a 15% sell-off, in the early part of this year, you've actually seen this indicator come back closer to its neutral territory. So that's an interesting move that's happened. So I think that's about it as far as the valuations are concerned. We'll just jump through to the next slide, which sort of sums up many of the points I've talked about. There is still uncertainty that we are dealing with regarding tariffs. What does uncertainty do? Companies delay taking investment decisions. And remember, a lot of the large capacity decisions that companies need to take are not just to service the domestic market. It's also to do with integrating into global supply chains. But how do you do that when you've got this whole uncertainty around tariffs? India's exports to the US, as I said earlier, are limited. Yes, there will be second order impact, but I think that will be a combination of positives and negatives, because this is not just a function of what tariffs are set relative to India. It's also a function of what are the tariffs that are getting set against India's competitors for exports. India's GDP numbers for Q4 FY25 very strong at 7.4%. Full year growth was at 6.5%. One caveat here, as you're familiar with GDP statistics, there is a GVA number and a GDP number. The GDP number gets affected by the way in which the fiscal balance is moving. And that's why 4Q was very strong for GDP, but that did not get reflected in GVA. And my sense is that if I were to look at 26, I would expect the momentum for GVA to persist, not really GDP. And which is why the central bank as well, in its forecast, which they gave last week, they were talking about 6.5% GDP growth for FY26 as well, which is a good number given all the uncertainty around the world, but maybe a peg lower than what our aspirational growth rate in India is, maybe a peg lower than what we would really believe is our true potential for growth. I've already talked about inflation, talked about how the MPC has changed its stance, how all of this is supportive for credit growth in India, how the Indian bond yield vis-a-vis US 10-year bond yields. The premium is a record low, but I don't think it's a mean reversion trade. I think there is something structural behind this move. The fisc is in good shape. Earnings, however, for FY26, I would be a little bit concerned. Large cap equity is still in the fair value zone for investment, not bargain basement cheap, but somewhere in that fair value. And from a style perspective, and those of you who are familiar with the India Dynamic Equity Fund know that our strategy is very quality growth. The years 22, 23, 24 have been very difficult for quality growth because value is the style which has been in great shape. But we think over the last 1 year, we are gradually starting to see a rotation in the cycle, and quality growth is starting to come back for multiple reasons, including the fact that the starting point of valuations for the broad market as well have now moved up a lot more compared to where the starting valuations were maybe 3 or 4 years ago. And our relative valuation comfort, as I said, is in large caps. So we have a preference towards strategies which have a larger exposure in India's blue chip companies. So that's about it from my side. I'll halt over here and hand over to Ajay, who will now run you through the India Dynamic Equity Fund strategy and positioning. Ajay, over to you.
Thanks, Vetri. And I'll very quickly cover a few slides on the fund, and also take, as is usual for us, a couple of examples from our top 20 holdings, companies where we are bullish and why we are bullish on them, and also show you our sectoral positioning towards the end. So straight off the bat, a very quick run on our North Star. We've always, put this slide right up front so as to, remind all our investors what we stand for. It is essentially the quality attributes of our businesses that we own in our portfolio and their ability to grow faster than India's nominal GDP growth that attracts us and that makes us bullish about such businesses. So we are firmly of the view that if you select businesses which are creating economic value and compounding that economic value at growth rates which are better than India's nominal GDP growth, then you would, as a patient long-term investor, end up making alpha. Of course, markets follow their cycles. Like Vetri mentioned, the last few years have not been great for the quality part of the market. In fact, the exact opposite has been true. Value has been on a roll for the last 3 years, and in terms of magnitude, that outperformance has been huge. In a way, not seen anytime in the last 20 years. Be that as it may, we firmly believe that our philosophy, as it has demonstrated over the last almost 15 years now, in the long term is a winning strategy, and we do have to endure these patches of underperformance or dry run if we were to eke out strong outcomes in the long run. Let's move on. This is basically our performance over the long run, right from 2011, the inception of the strategy till date. As you can see, strong performance across years except for 2022, which was a very bad performance. As we know that as interest rates went up, growth and quality did suffer. In India, unfortunately, it continued to suffer for a prolonged period. The good news is that we have already seen signs of reversal. Starting off April, May of 2024, we've seen a reversal in style. And for portfolios like ours, which have been very firmly pivoted at the quality end, we have also seen a very sharp reversal in performance. So as you can see on a one-year basis, as is shown in the bottom table, the fund has outperformed significantly. Let's move on. If we look at what's worked for us and what's not worked for us over the last 1 year, I would say notwithstanding the volatility in IT services, mainly because of this fear around tariffs that US is wanting to impose on all its partners, leading to inflation and also recession, still some of the stocks that we have owned in the IT services have done significantly well. That may not be sector per se. The sector may be only a slight outperformer over a one-year period, but we've always taken great pride in the fact that we are bottom up. What matters to us is more the outcome of businesses over the next 3 to 5 years rather than just taking a top-down view. And I think that's also being displayed in our stock selection within IT sector over the last 1 year. Likewise, I would say, India, which has been pushing the envelope on manufacturing, the government's favorite project of the last few years has been to incentivize manufacturing in India. We all are aware of Apple shifting a lot of its manufacturing to India. There are electronic manufacturing companies which have done a good job. One such business for us has been Dixon, which we've been owning for the last 3 years. Though it doesn't manufacture for Apple, but it does the same for a lot of other global IT products companies, including PC and laptop manufacturers and also mobile manufacturers. So that's also witnessed a very strong run. What's not worked for us at the bottom are a few businesses in building materials, a few names in industrial consumables, and a few consumption-oriented names which have also lagged. Yeah, let's move on. I just alluded to the pivot moving away from value towards quality just a while back. And as you can see here on the left-hand side, we have data right from 2006 up to 2024. And we can, on the left-hand side, the first column is basically the quality index. Then the one next to it is the value index. And you can see the relative outperformance and underperformance of these two indices over the years. If we go right at the top, you can see that from 2021 all the way up to 2023, there was a very sharp outperformance of the value part of the market against quality, and that obviously did have consequences on portfolios like ours, which is heavily pivoted towards quality. The good news is that this has started to change. Now, if you look at the right-hand side, the small table, uh, January of 2024 to April of 2024, just in those 4 months, quality underperformed by 22%. So that was something which was very stark. But as we all know, when the markets are just about to change their direction, the last leg is always something which is irrational. So that irrationality, went to an absolute extreme before the pendulum started to swing to the other side. What we have witnessed between May of 2024 till date, almost the last 1 year, is quality outperforming. Now, I do want to mention it at this stage that in these cycles, which typically last for about 2 to 4 years, it is only obvious that there would be a few months and quarters when you would see a bit of a pullback. So if the trend clearly is in favor of quality today and would remain for the next few years, it doesn't mean that every month and every quarter quality will continue to outperform. There will be pullbacks in value. There will be time periods when value will outperform, and we are completely appreciative of that, and we would remain patient through these phases rather than just panicking and making any changes in the portfolio. Yeah, let's move on. So, this is an interesting table, and I do want to spend a couple of minutes here because, in a way, this is linked to what our view about the next few years in India would be. So, I must make this disclaimer that none of us have a crystal ball. So, obviously, we don't exactly know how the markets would behave. But looking at the past, we are only trying to show you data around how markets in India have behaved during different time periods. To do this study, we've picked up 4 indices. We've on the style quotient, we have picked up the value index and the quality index. On the market cap spectrum, we have picked up the mid cap index and the broader index, which is Nifty 500. We've tried to measure them on a 1 year, 3 year, and 5 year rolling basis. The idea was to have a good understanding about how markets behave, not only from any one time frame perspective, but through multiple time frames. And that's why 1, 3, and 5 years. While doing this study, we thought let's just break up the market into 3 different buckets. We call them the bullish phase, the bearish phase, and the more normative or the more rational phase. We've defined bullish phase as that phase where the markets are giving more than 15% return, not just over any 1 year period. Of course, in any 1 year, markets can be even up 50% or down 20%. But if markets are higher than 15% for 5 years, on a compounded basis, then certainly it qualifies as a bearish phase. Just like if markets are negative, not just for a year or two, but negative for 3 and 5 years as well, it does define as a bearish phase. The more normative phase is what you see in the middle. Now, a few things are obviously intuitive here and a few are not. The intuitive ones are that whenever markets are bullish, do expect mid caps to do well, do expect the value part of the market to do well, because this is the time when risk taking is on. This is the time when people don't want to, remain invested into steady compounders, predictable businesses, but people want to actually take higher risk and therefore go down the quality curve and try and invest into companies which can go 2x, 3x. So the catchphrase during these phases is that buy the poorest of businesses because they would have the highest potential of re-rating. And this is something which happens every time during bull runs, and that's something which happened between 2020 and 2024 as well. That's been a very strong bull run for the Indian markets. I'm repeating, mid caps do well during these phases compared to large caps, and so does the value style. The exact antithesis of this, and this also is perhaps intuitive, is when markets are bearish. This is the time when people want to be invested into safer businesses, i.e., large caps. They want to be invested into strong balance sheets, predictable business models, predictability in terms of profitability and margin, so on, which again means that people want to, during such times, invest into quality, and therefore, no surprises that value and mid cap which were the best performing parts of the market during bullish phases, become the worst performing part of the market. The not so intuitive period is the middle one. And we were also surprised to look at the data, because when markets are turning cautious, they're still positive, but they're not overly bullish. They're turning cautious. This is the phase when, once again, does well, and does so by a margin, not just over a 1 year time frame, but over longer time frames as well. And if you just try and correlate this with what's happened in the last 12 months, we've seen the bullish phase of India fade into a more rational phase. We've seen returns become a more moderate single digit returns, obviously because the starting point valuations in 2024 were very high, and therefore surprises that silently the pivot has already moved towards quality, and value and mid caps have relatively started to underperform. So, we do expect that markets will remain in this zone for the coming years. We don't expect, markets to give mid to high teen returns, at least not for the next couple of years, till such time that valuations get back into the attractive zone once again. Until such time that this happens, once again, quality, which, has done well over the last 20 years during all such phases, to our mind, should continue to do well. Yeah, let's move on. Coming back to the strategy, how it has behaved, of course, we are looking at, the dangerous thing about statistics is that, you choose the starting point and ending point, and you can pretty much prove or disprove any hypothesis. So therefore, it's always good to look at multiple data points across time periods, hence rolling returns. And what we have done here is, for our, strategy right from 2011 till date, we have basically looked at 1 year, 3 year, and 5 year rolling returns. And we have figured out what has been the percentage of time that over 1 year or 3 year or 5 year that we have created alpha against the benchmark. And over a 5 year period, even on a net basis, which means after expenses, 80% of the time we've been able to generate alpha, and that number over a 3 year period is 78%. So yes, the strategy does do well in the fullness of time, but like any other strategy, it will have its own share of underperformance or phases of underperformance. I think we've just come out of a very bad phase of underperformance, and there is evidence that we are starting to gain ground once again, mainly because, like I said, we've stayed committed to high quality businesses, which we feel in the long run, do well, and the markets have started to gravitate towards that once again. Let's move on. I'll just give a couple of examples now, which are stocks that we are bullish on the portfolio. Our attempt every time is to bring out, different names and not repeat the same names. And this time we are discussing a company called Eicher Motors, which is, India's #1 premium cycle player. By the way, two things that keep us excited on this. Number one, if you look at two-wheeler penetration in India, that's somewhere in the mid-teens. So it's not as if India is, in terms of two-wheeler penetration, already a saturated market. But more importantly, if you were to look at, the two-wheeler market, only 8% of this market is mid-sized motorcycles. Obviously, mid-sized motorcycles are much more expensive than what we call as entry-level or economical bikes in India. But as per capita income is increasing, the growth rate in this part of the two-wheeler market is significantly higher than any other part of the market. And I think this will continue to play out, while two-wheelers itself will remain a growth industry. But within two-wheelers, we would continue to see premium motorcycles remain high growth. The company is also making efforts to get outside of the country and, find market for its range of bikes into predominantly emerging markets in Latin America, in Asia, and Africa. If you go on to the next slide, we would see the outcomes of Eicher over the last 10 years. Very, very strong outcomes in terms of profit growth, revenue growth first and then profit growth, while maintaining strong return on capital, strong cash flow generation, and strong ROCs, which on an average have been about 44%. So a typical business which we would love to own in the portfolio for the long run. It will go through its own cycles. Two-wheelers as part of the auto industry are discretionary, a part of the market, and they do see their own cycles of strong growth and also at times weak growth. But we remain committed in terms of our view of mid segment bikes in the country doing well over the coming decade as well. The next example that we're giving is again a company we've not discussed in the past. This is Polymedicure, a company which is basically one of the leaders in the medtech space in India. By the way, I spoke about manufacturing. Medical devices is again one of those industries which the government is pushing. There has been a lot of imports in the medical devices space in India all along for many, many decades now. The government does want to change that. It wants to incentivize players to do a lot of local manufacturing here. And Polymedicure, which has 20 years, has actually been a beneficiary of this. Of course, because of its own efforts of scaling up the business, but now also because of tailwinds on account of government policies. So, this company once again has shown very strong growth. There are a few areas in which, this company specializes. In these specialty areas, it's also, a big player in Europe, but is now trying to get into US to crack that market. And as we all know, US is the largest market when it comes to healthcare and medical devices. The next slide carries the outcomes of Polymedicure over the last 10 years. Fairly strong, once again, 16% growth in revenues and 18% growth in profits, while maintaining fairly respectable return on capital of around 24% and ever increasing string of cash flows through these years. Let's move on. A couple of more slides before we just open up for Q&A. This is basically the snapshot in terms of our sectoral view. As you're well aware, we don't swing too much in terms of our portfolio holdings and also in terms of our sectoral outlook. So there are a few sectors where we have been negative, mainly because we find it a struggle to actually, on a bottom-up basis, identify businesses which come from these sectors and can display the economic characteristics that we love. So utilities, energy companies, metals and minings, these are fairly commoditized stroke cyclical sectors with poor outcomes in terms of profitability, cash flows, weak balance sheets, high debt, and so on. So we always find it very difficult to play our quality growth strategy by identifying businesses from these sectors. On the contrary, our bullish stance on consumption continues. In fact, we have over the last 4 or 5 years, we've increased our exposure in consumer goods and services. It's our view that if India continues to do well, consumption will continue to do well. That A is the bedrock of India's GDP. Number two, despite we being the fourth or the fifth largest economy, about to become the third largest in the next couple of years, I'm always fixated on this number of per capita income, which is $2,500, which means it is extremely poor compared to even other emerging markets. So there is enough and more room for India's consumption trends to continue remaining strong. We love owning businesses. We have created a niche for themselves, have a very strong differentiation and a brand recall across different facets of consumption. And that's what we remain most bullish on. Of course, we are also bullish on healthcare and IT sector, along with banking and financial services, which is slight underweight against the benchmark. But it's still a very large position for us, almost a quarter of the fund. And here we are excited only on private sector banks, which have shown a very strong credit underwriting track record over the last few decades. So here again, we will see phases when the much more steady Eddie private sector banks don't do well, but the PSU banks, which are typically trading very cheap across the cycle, but at certain points of time are extremely cheap, end up doing well for certain years. But our focus remains on the strength of underwriting and ability to gain market share, which is what we have witnessed in a few private sector banks, which are some core holdings in our portfolio. I'll move to the last slide now, which is basically on our top holdings. Again, you won't see much change, but yes, as is our typical behavior, we identify companies, we start with them with a small exposure of between 50 basis to 1%. We watch them for a few quarters before we get excited. On this slide, you would see a few changes. Zomato, which is now called Eternal, which we purchased first in 2021, over the years has now grown to a large position of 4%. Similarly, Dixon, that poster boy of electronic manufacturing in India, which we bought first in 2022, was not part of the top 15 holdings last year, is now the 12th largest holding for us at a weightage of almost 3%. Last but not the least, Trent, India's fast fashion champion, has also made its way over the last few years to a 3% position. So no big changes, but yes, slowly and steadily as we gain comfort on our businesses, some of those businesses which we think are scalable and scalable along with, profitable growth are the ones where we also keep scaling up our exposure. So with that, I'll stop here and I'll hand it back again to Shweta for Q&A or yeah.
Thank you, Ajay, for that insightful deep down in such a short time. Really appreciate it. Let's now open the floor to questions. We see a few questions flowing in through the chat box. We'll try to address as many as possible. The first one may be for you, Vetri. How should one understand the ever-evolving situation of tariff levies by the US on India? Would it be a tailwind or a headwind for India relative to other nations? Also, in the same breath, comments on the insistence of production lines moving away from India to the US.
I mean, to cut a long story short, I don't think I can give you too much clarity beyond what's already circulating in the headlines. As I said, this is still a moving and an evolving issue. We don't have a settlement either with India or, for that matter, with the other geographies as well. It's certainly, if the tariff level is fixed higher than where it used to be prior to this, some Indian companies, some businesses may get impacted. But equally, because the likelihood of tariffs being set on many other geographies is going to be much higher over there, it creates an opportunity for India. So, really what I would say is this is a space where one still needs to continue watching. Our thought processes right now is to remain focused on the fact that as long as we own good businesses, they are globally competitive, they have the ability to navigate cycles, we'll wait for, things to settle down before seeing if anything requires to be revisited at all.
Thank you, Vetri. Maybe the next question for you, Ajay. Can you elaborate on why IDEF remains well positioned in the next phase of the quality cycle?
Yeah, Neha, thanks for that. Interesting question. I think in one of the slides that I had discussed, we did show about how markets keep changing their mood, how bullish phases are the ones where, mid caps do well, where the value side does well. And as soon as the markets get cautious, by the way, they're still not bearish. So we're not talking about, markets giving negative returns, but the markets are cautious and therefore, in that range of 0 to 15%, that's where quality, again starts to do well. That's what has happened over the last 12 months, by the way, much before any one of us could realize what could be the reason for markets, changing their direction. I think this has started to play out already. And, it's our view, Vetri showed charts around India's valuation. It's our view that given where the valuations are, markets are not going to be, giving mid-teen to high-teen returns over the next couple of years. It will be a more measured return over the next couple of years. And these are just, fertile grounds for the quality style to do well. Yeah.
Thank you, Ajay. Maybe just building on that, another question quite related. We have seen underperformance of quality strategy year to date. So what are the likely reasons and what supports our quality cycle forward alpha narrative in this backdrop?
Sure. Interesting one. Once again, Neha. And again, I did try to touch upon this. See, in a cycle which is going to last for, let's say, 3 years, you would obviously have phases when the style doesn't do well, when something else, some other factor does well. Maybe mid caps do well. Maybe the momentum factor does well. The trend clearly to our mind is in favor of quality. You would have these short-term phases where maybe quality doesn't do well. One of the reasons that comes to my mind looking at how markets have behaved is if you were to just break this phase of the last 4 or 5 months into two phases, Jan Feb being the phase when markets saw a sharp sell-off, and then particularly April and May as phases when the market saw a sharp run-up. It's more in the latter phase that we have underperformed. So as markets have seen a very strong beta rally over the last 2 months, to my mind, it's been only obvious for a low beta strategy like ours to underperform, which over this year to date period is also leading to a slight underperformance. So yeah, that's the reason to our mind. Yeah.
Thank you, Ajay. Maybe the next question for you, Vetri. What's the biggest catalyst for investing in India at the moment? And what are the supporting tailwinds to spur India's growth in the next 1 to 2 years?
Sure. I'd say the biggest thing working in favor of India is just that the fact that the Indian ship is very well placed to sort of navigate what looks to be multiple headwinds and crosswinds in the global, trade and capital environment. The reason I say this is that the economy is still to that extent, of course, driven more by domestic growth than it is by exports. So that's one thing which buffets us. The second thing which buffets us is really the fact that in this environment where I said every trade war is also a war for capital, the domestic liquidity is still very strong. This kind of consumer surplus of savings moving towards equities is very strong. So that's creating a more balanced environment in the market. And eventually, I would say it's India's macro-prudential approach, which places it very well because we've managed our fisc and our monetary very conservatively over the last few years. And what that does is that places us in a position where we can respond to the headwinds and the crosswinds because we have policy flexibility. And I would not undermine the importance of having the ability to respond. I think many countries around the world have driven themselves to such macro imbalances that they don't have the room anymore to respond to, shifting situations or evolving situations. So that in a long story is what I think places India in a very good situation.
Thank you, Vetri. The next question, maybe for you, Ajay, is in India, there's often a relatively high correlation between small and mid-cap stocks and fund performance. So, how have you reduced this risk or taken advantage of this?
Neha, we always want to take advantage of this. It's an all-cap strategy. If I look at how our portfolio composition has been over the last almost 15 years now, large caps have been anywhere between 60 to 70%. Mid plus small caps have been anywhere between 30 to 40%. Now, we are not committed to any particular number. We don't want to drive the portfolio towards a number, but it's our stock selection and the opportunities that we see around ourselves that finally leads to these numbers. And we are just given the fact that we are the oldest asset manager, we have one of the largest and one of the most experienced research team. It's only natural for us to spot many of these businesses right at their infancy. And then, like I explained a while back, after being reasonably sure-footed about the outcomes of these businesses, about their quality attributes, we start building exposure slowly and gradually. And as incoming data supports our hypothesis about their quality and their longevity of growth, we keep increasing exposure. So I would say we've always taken advantage of this in our all cap strategy. First of all, being selective and not just getting too excited about anything and everything within the mid and small cap bucket. Do remember there is a survivorship bias in the data that we always see. So we also are conscious of that, and therefore we run our hygiene checks before we get excited. Once we get excited, slowly and gradually increasing exposure. So yes, we are well placed to take advantage of this in the long run, like we have in the past. There have been many businesses which we bought 5, 10, 15 years back, which were small stroke mid then. And these are the businesses which have actually given the best returns over the following decade. Yeah.
Thank you, Ajay, for that. See, another question, very macro related. So maybe Vetri for you, what is your understanding on India-Pakistan conflict?
Yeah, I did see that question. Let me put it this way. This India-Pakistan conflict is not new to most of us, either growing up as Indians or even in a stock market context. But the volume of discussion about India-Pakistan has come down very significantly over the decades. I know when I started my career in the early 90s, this was a topic because there would be friction almost every few months. There would be some incident on the border. And I think over time that has really come, sort of tailed off. Now, every time there is a big terrorist incident, of course, India does feel the need to respond. And very clearly, there's been a change in the strategic thought process and a willingness to go up the escalation ladder, which perhaps India avoided in the past. But I think, from India's point of view, and at least that's the message we get from a lot of the policymakers and government in Delhi, is that they feel the need to impose costs, which have been, when innocent lives have been taken. But at the same time, I think India recognizes that really the most important thing for us is to sort of keep growing the economy over time, to address the needs of our citizens, to address the needs of our population. And, as India becomes a larger and larger economy, I think the ability of Pakistan, or for that matter, any country, to sort of, hurt India's long-term interests would be very, very limited. So it's careful calibration of that escalatory ladder. Obviously, it comes with risk, but I think, the policymakers and government in Delhi are also very focused on making sure that nothing disrupts India's long-term growth prospects.
Thank you, Vetri. While you're on the call, and maybe in the interest of time, we'll take up this last question. Any comments on the recent trade deal between India and UK, and could there be more such deals in the near to medium term?
So, India has been exploring deals for a very long time, Neha. The UK discussion has been going on for 5 to 6 years. We have a deal with Australia, but that's not really been signed, sealed, delivered in terms of dotting the I's and crossing the T's. There's one going on with the EU. There's one going on with the UAE. So I think India has a lot of specific interests related to the farm sector, related to certain other sensitivities, where it feels it doesn't want to have a complete open source trade deal. But I think because India has also felt that regional alliances don't work in its favor, it's much more comfortable working out specific bilateral deals with large economies. And I would particularly point to EU, of course, in a way. Originally, UK was obviously part of that. And then there's the US. And then, of course, you've got, Australia and the Middle East as well. So I think it is India's policy to try and work out those kind of bilateral agreements. Also because India's sort of confidence in multilateral agreements is not all that great anymore. So I think you could see more of such transactions. But, don't expect any of them to completely sort of disrupt the dynamics, because India's, got a lot of sensitivities that we need to handle.
Thank you so much, Vetri. Maybe in the interest of time, we'll have to end the session. Thank you, Ajay, Shweta, Vetri, for all the insights. And thank you all for joining. And if you still do have questions that you'd like for us to address, feel free to send it over to your sales representative. Thank you again for your time.
Thank you.
Thank you, everybody.
Thank you.